Okay, now that we've gotten an idea of what the accrual basis of accounting is all about and focuses on the earning of revenue and the incurring of expenses, when have we done the work required to earn the revenue, whether or not we're a service company or a manufacturing company or a merchandising company? Let's take a look at some transactions. So, if you haven't had a chance to download the handout from Moodle, please do so. It's out there. Again, bearing in mind, we're going to continue to work a lot with the framework. If you don't have a chance to get that downloaded and in your hands, maybe it'd be great to just grab out a sheet of notebook paper and create your own framework for these transactions that we're looking at here for Chapter 2. So the first transaction, Cato Consultants, was started on January 1, 2018 when it acquired $5,000 cash by issuing common stock. Hopefully this sounds like a transaction that we saw in Chapter 1, right? This is a repeat transaction. We should all be comfortable with what we need to do to record this transaction. Was cash impacted? Yes or no? Okay, great. Cash was impacted. Did cash go up or did cash go down? Cash went up. We received money from the owners that wanted to buy these shares of common stock. The other account that will impact is our common stock account to show that we sold those shares of common stock. What you'll also notice over here on the right is that our statement of cash flows, this is a new column in this framework. You'll see this in the online homework when you get to it for Chapter 2. We're keeping track of our statement of cash flows activity. We're dealing with our owners, our common stockholders, our shareholders. So what we notice is that this is flagged as a financing activity because we're dealing with our owners. Cash went up by $5,000. So our statement of cash flow also shows that increase and attributes it to the financing activities section. Okay, so hopefully a familiar transaction. Let's take a look at a new transaction. This transaction doesn't sound like anything that we saw in Chapter 1, but close. During 2018, Cato Consultants provided $84,000 of consulting services to its clients, but no cash had been collected. So no cash was collected. So it's telling us that cash was not impacted. But we provided consulting services. So we did the work to earn something, but we haven't been paid. Do we have revenue? We do have revenue. We've provided the services. We've earned the revenue. We've earned that $84,000 even though cash hasn't been collected. Whenever we have revenue, remember we want to go right to our retained earnings. Our income is increasing. We have revenue. Let's start there. Let's add $84,000 to our retained earnings account. What else is being impacted? In Chapter 1, we always had cash. Here in Chapter 2, we don't have cash. How are we going to get this transaction to balance out? If you're thinking about accounts receivable, good job. Way to go. Accounts receivable is the account that we need to go to. We need to show that we are owed money. The opposite of owing someone money is when we are owed money. We are owed $84,000 from these clients, from these customers. So what we'll have is we'll have a new asset account, and we'll call that account accounts receivable to show that we are owed that money from those customers. Notice a few things also. Our retained earnings is going up for that revenue. Our accounts receivable account is going up for the fact that we did not receive payment from those customers. Notice, because cash was not impacted, there is no impact to our statement of cash flows. Okay? All right. Let's take a look at another transaction. Cato collected $60,000 cash from customers in partial settlement of its accounts receivable. So we've received payment from some of those customers that owed us on account. Was cash impacted? Yes. Cash is impacted. We collected cash. Cash is going up. Great. Okay. What else is happening here? Partial settlement of its accounts receivable. Accounts receivable is impacted. Is accounts receivable going up or is accounts receivable going down? How is accounts receivable impacted when we receive payments from our customers? Well, do we want to show that they owe us more money or that they owe us less? When they make a payment on account, they owe us less money. What we need to reflect then in that account receivable is that less money is owed to us. So let's show the increase in our cash account and let's show that account receivable coming down. So again, what we're seeing is our cash account increasing, our account receivable account decreasing. These two together make a zero. 0 on the left, 0 on the right. Our accounting equation is in balance. We're good to go there. Also notice we're dealing with our customers. So this statement of cash flow impact, $60,000 related to our operating activities. Fantastic. Let's take a look at another transaction. Cato paid the instructor $10,000 cash for teaching training courses, salaries, expense. Does this sound like a transaction that we saw in Chapter 1? I hope so. It should. We paid cash for an expense. What happens when we paid cash for an expense? Was cash impacted? Absolutely. Does cash go up or down when we pay an expense? Great. Cash goes down. Cash goes down by $10,000. What else happens? Expense. What do we always go to whenever we have any expense? Our retained earnings. Earnings is decreased when we have our expenses. So we can go to our framework and see that cash is going down by $10,000. Retained earnings is going down by $10,000. Also notice our statement of cash flows in the far right. Cash is going down by $10,000. Who are we dealing with? We're dealing with our employees. Employees are part of our operating activities. So we flag that decrease in cash as an operating activity. All right. Let's take a look at another transaction. Event 5. Cato paid $2,000 for advertising costs. The advertisements appeared in 2018. We're working in the year 2018, and we paid for a cost related to that year. Hopefully this sounds like a familiar transaction. We can think of any cost, any expense. We could use those words interchangeably. So we have another cash expense. We paid $2,000 for an expense. So just like we had with our employees' salaries, the same is true here. Cash is decreased for that cash expense. Retained earnings is also decreased. And again, we're dealing with a vendor an advertisement agency, a local newspaper, whatever the case might be. Maybe we're putting an ad on Google, and our statement of cash flows is also being impacted by our operating activity. Very good. Let's take a look at another event number 6. Cato signed contracts for $42,000 of consulting services to be performed in 2019. Do we have anything to record? Was cash impacted? No, it doesn't tell us that we collected cash. It just says that we signed contracts. Have we done the work? Have we performed the consulting services? Have we earned the money related to those contracts? No, it's telling us that the services are to be performed in 2019, next year. So we don't have any cash coming in. We don't have any services that we provided. We don't have any revenue yet. We haven't earned the revenue. This could be similar to, when you read in the newspaper that, LeBron James signs a big contract with the Lakers, okay? Until he performs in the games, until time passes where he actually earns his pay, there's no transaction that we need to record. There's no liability to the Lakers. There's no expense to be reflected related to that. But if there's a signing bonus, when's the signing bonus earned? When do we have the expense related to a signing bonus as a company? As soon as the employee, the future employee, signs the contract. So if there were a signing bonus, we would recognize that expense at the time of the signing of the contract. In this example, we don't have a signing bonus. We just have contracts that we're going to do some work in 2019. Maybe it's in January, maybe it's in December. When it's actually going to happen is irrelevant because we're working in 2018. So we're going to perform some work next year, but for right now, there's nothing to record in our framework. At the end of 2018, Cato recorded accrued salaries expense for $6,000. Salary expenses for courses that the instructor taught in 18 that Cato will pay cash for in 19. What we're saying here is that towards the end of December, we had our instructor go out and teach a course. They earned $6,000 by doing so, but we haven't paid them yet. We owe them that $6,000. So what do we have? We have an expense. We're going to retained earnings. We have an expense. We are going to retained earnings. Retained earnings is coming down. Was cash involved? No. No cash changed hands. So we're going to use this salaries payable to show that we still owe this employee that $6,000. We'll pay them at some point in 2019. Notice again, no cash impact, no statement of cash flows. Okay? Feel free to rewind these videos, pause them, make your notes. I moved a little faster than we do in class, only because of that fact. So please feel free to watch these as often as you need, make your notes, and be ready for class next week. When we get going in class next week, we're going to continue with Chapter 2. The second key word that you need to include in your email to receive attendance for class on Thursday is rocks. Rocks is the word. Have a great day.